Good morning, ladies and gentlemen. Well, the Ristyle finished the week at 64, which is actually the highest reading for the week. And if you needed any better proof that this model has absolutely nothing to do with price, you got it, because we've been going down all week and the Ristyle has been actually very stable all week, and then on Friday it rose. So what is it saying? And this is a model which follows thousands of price spreads. It's saying basically that nothing has changed. All that happened is that we had a retracement in price without any deviation of the trend of the spreads. So all the spreads continue to do better. All the moving averages in the spreads continue to do better, and there is absolutely no reason to panic at these levels, not on a daily basis, a weekly basis, or a monthly basis. On a weekly basis, we are making a new price high, and also on a monthly basis. So absolutely no reason as far as spreads are concerned to be overly concerned by this small retracement. Deviation Land basically told you not to be surprised. Every time the price goes into the red, it comes back. I really would not be surprised now to see, what with the elections ahead, a repeat of this kind of pattern. I don't think we have established a proper long-term low here, but I will discuss that later. I think, basically a trade between the middle line and the top of the deviation in the red is what we can expect for the next several weeks, because I don't think this is going to be resolved anytime soon. We have too many uncertainties. The market needs to stabilize. It's been overbought for so long. This kind of level, together with this, the direction of the center line, should hold the market, and really we should be panicking in place, i.e. going up a little bit, then panicking down, but the net result is going to be very little overall. If you have a look at what the individual sectors are doing, you will see that they're all closing in on their middle line, and they will basically oscillate either side of it. The one that was the most overbought, i.e. XLK, has finally given up and basically come back to the level where it started going into the red deviation line. That is what the price normally does, is that it retraces all the way to where it started getting overbought, and then it stabilizes. And I really don't expect much price net price deviation over the course of the next couple of weeks, but I do expect overall that the market will test lower and hold, but I will examine that in detail. But now let us look at why the Ristyle is doing nothing, if not doing better. Bondland is stability itself. The 2s10s are doing absolutely nothing. They're oscillating a couple of basis points either side of 53 and staying extremely stable. Germany, if you look at the 5 years, they are very stable within the corridor. I mean, this is a corridor of what, 10-15 basis points. There's absolutely no reason for the spreads to start doing anything. The only thing that is going to kill this bull market is going to be bond yields and the curve, and neither is moving to any degree at all. So here we have the 10-year Bund doing absolutely nothing, basically stable within 10 basis points. And the big event next week is going to be the ECB, and that is more likely to be dovish than anything else. The spread against the US dollar in terms of spreads in the you can see that it's basically for weeks now it's been around the 110 to 115 basis points, and it's doing absolutely nothing. Why should the market have any kind of, why should the risk market have any kind of reaction rather than a technical reaction? We're coming up to election time, people are lightening up, it was very, very overbought, that is being worked off. That is all that's happening here. There isn't a single component that I look at which is screaming, be careful about what is going on at the moment. The most important part of the US curve, the 530s, and I've told you many times why I think that is now the most important part, because fives are basically anchored to twos, so basically you're looking at twos 30s. While, and I really can't stress that enough, while the Fed is engineering a soft landing of this curve, i.e. that it doesn't go past the 140 level, and it stays, and it stays between 105 and 140, I really think the equity market is comfortable. The risk market is comfortable with that kind of spread between 530s. If it now starts falling below 100, that would be possibly a risk-off move. Certainly XLF wouldn't like it, but also it would be a sign that people are moving into longer dated yields because they are afraid of the risk market. But while it stays above above 140, I'm also quite comfortable, because it seems that the 140 over 0 is roughly 150 basis points, right? So if long-term yields can stay anchored around the 1.5% level, I think there is very little danger to this rally in risk. Let's have a look in detail at what actually happened last week in terms of relationship between sectors. XLF over XLK, a small rally back, but the direction of the trend is quite clear. Same thing in XLV over XLK, and same thing in XLI over XLK. Just retracements of a secular trend and nothing more. Any time that you have the tech sector, which is now by far the largest component, giving up ground to the other sectors, unless those sectors rotate significantly higher, you're going to get a weakness in indices. That is all there is to it. You just have to look for the level that stabilizes tech, and that will also be the level where the indices stop going down and start rallying. Really, there is no greater magic to it than that. Unless these other sectors are themselves weak, then the indices will just stop going down and reverse on a dime. Here we have the VIX, which is the volatility of the S&P, and here we have the volatility of the Nasdaq. You can see how it really broke much higher last week compared to the VIX, and this tells me that although you can see how we are unlikely to break out above these previous highs, because it just isn't technically feasible at the moment that we should do so, because the Bollinger Bands are, unless we're going to have an event like in February, which I think is extremely, extremely unlikely. The odds of that are very, very small. That was an exogenous event, and this is a technical event. The volatility of the Nasdaq is basically going to remain at these levels. And I think now the volatility of the S&Ps is really unlikely to go much below 27. In which case, basically what we are seeing is some sort of a panic in place. And that's why I titled today's video Panic in Place, simply because I think we're going to have a situation whereby we have squeezes and then repeated downdrafts over the course of the next 3-4 weeks. And that is going to be basically a range between this 28 and 36 level, and something like even higher here in Nasdaq, something no higher than 50 when we get to really bad situations. But we will basically be volatile for the next several weeks, simply because we are getting a situation that people need to probably lighten up into and want to lighten up into the election, and it's unreasonable to expect that we will be calm or continue rallying into an event which is probably going to be a binary outcome. I think the market resolves higher, but I think for the next 3-4 weeks we are going to see a period of sustained volatility, because I think the likelihood of us not seeing that is smaller than the likelihood of us seeing it. I still think that anything that happens while volatility is below 43, VIX is below 43, is still a positive event, and these 43 events, when they match up with a low, a reasoned low in the SPX, are definitely buys. This is the transports and this is the Dow. I just want to show you that the weakness is very much localized in basically what it should be localized in. It's a retracement in what was going up at a ridiculous pace, which is tech. But we are getting slightly, if you look at the MACD on the daily, it has crossed over. It is suggesting a period, probably something like this, where we test lower and hold and basically do some sort of a W squiggle. But the transports on a weekly basis were hardly changed. Stayed strong all week, didn't even break the low of the previous week. It basically is saying that this is a localized event. There is deflation going on in an unsustainable price appreciation trend, which was the Nasdaq. So look at the Nasdaq, have a look where the volatility of the Nasdaq matches a reasoned low on the chart, and that is your risk reward level for longs in everything in terms of risk. From everything I've said so far, I think it follows that it really pays to have a look in detail at Nasdaq. This is the monthly chart, and we are still above the monthly Bollinger Band. What are the natural levels from a monthly point of view? The first level, and we just touched it, 11,120, which is the 23.6 retracement of this whole move. And then finally what is, I don't think is that likely, is 10,260, call it 10,300. This is from a monthly point of view. Okay, this could be a multi-month thing. It could take 2, 3, 4 months to achieve, but that would be a reasonable retracement and absolutely do nothing to the long-term trend but make it healthy. Okay, so if we get a repeat of this kind of price action here, in here, why would that be surprising? Why would that be the end of the world? Why would that bother anyone? It really shouldn't. So I just wanted to show you the monthly so we have some context. And last week I said that basically real support was on this like 11,060. Basically, you can see that we have held this moving average every time we've tested it and then progressively gone higher. I think this time it's probably not going to be as simple as that. That was a great risk reward level to buy it from, and you can see the 0.618 retracement from the low to the high was 11,130. It touched it and basically zoomed up. What is likely to happen here? We are likely to have to produce some kind of an ABC retracement on the weeklies and the dailies. We only have it on the hourlies, and that is really not good enough. Not ahead of a US election where the outcome is so important, and also not good enough in time. We have spent such a long time rallying up in a straight line that I think some more consolidation here would be great. Basically, we are transitioning from a buy the dip scenario to a buy the dip and sell the rip. We're going to be doing both. We're going to be selling the rips and buying the dips. I think next week any kind of retest of this 11,127 is probably going to hold this week, and we will actually over the course of next couple of weeks ascertain where the B leg actually is. If this is the A leg, we need a couple of weeks of holding these lows and going up towards, 12,000, making the B leg there, and then having the C leg come down to say 10,300. Who the hell knows? But that is what I think is more likely to happen. A period of stability, relative stability, and then finally a spike down before we start going up. I think we are now within, less than 2 months to go to the election. It is probable that we get a period of more sideways to down action over that period than we are to just scream back higher because we touched the 0.618 retracement of this move. I think it's more likely that we get a period of sideways and then finally one last panic down, and then we break higher and into year end. If we look at the dailies, we just need so much more definition here. We need rallies up to 12,000, and this green moving average that's turned down. We need rallies. If we actually enlarge this, we just need to get some definition here. This has been too quick to give you any kind of targets. We need probably 11,954 down to 10,765 to get that kind of a definition going sideways. So basically, everything I see says transition from just buying the dips to buying the dips and selling the rips. It is obvious now that Bollinger Bands, RSIs, and all these technical indicators do matter in the end. You just can't keep on ripping things higher, and the fact that we're still above the monthly Bollinger Band tells me that these rips are now going to be sold, and that the reason why people are taking volatility higher is because eventually ranges will be larger. I don't have an argument with that. Ranges will be larger in this in the NQ, and therefore I think there are going to be plenty of opportunities to sell the rip and buy the dip. And eventually I do like this area that we spent such a long time working around, which is 10,300 to 11,000. I think there's a whole load of volume here, and these people need to be made uncomfortable at some stage. Getting a dip down here is going to make them uncomfortable at some stage, but I think that this is a big risk reward positive area, because I don't think the rally in NQ is anywhere near over, and I don't think the rally in SPX is anywhere near over. SPX, basically the NQ's less volatile twin, is needing a lot more definition. I mean, we are now finally acknowledging that weekly and monthly Bollinger Bands matter. They've always mattered in SPX. We are finally below the monthly one. I haven't shown you that, but believe me, we are finally below it. And really, all we've done here, this is where the point where we rallied from for the past few weeks in a straight line, and all we've done is retraced to the 38.2 point retracement. We are likely to do an ABC. I really can't see it much higher than this kind of level, 3480 to 3500 and odd, and then we are at some stage likely to test lower. And to me, this 3276 area down to 3203 is going to be a wonderful buy area. 3280 to 3300 I think is going to be very, very hard to break for the next couple of weeks, and I think any kind of dip down there is going to be a monstrous buy. Late on Friday, I sold a whole load of 3300 and 3280 puts, taking advantage of the high level of volatility and the very low period of time to expiry, because I really do want to be long there. I think the risk reward 3280 to 3300 for a reaction back up is going to be, very decent. And even if it goes down through me, I will see those levels again. I'm absolutely positive. So I really think the best way to take advantage of this situation over the next 2 or 3 weeks is going to be selling out of the money puts, taking advantage of the high theta and also the high volatility that the market is going to afford you. Anytime we see the market down towards 3280, I think that is going to be a wonderful opportunity to see reactions on a daily basis in XPX. We just need definition. Okay, this has gone down too fast to be a completed leg. We need retracements back up towards 3500, and then we need another low. What is the ideal level for a really good sustainable low? I would argue 32, 33. Notice that we haven't been below the bottom Bollinger Band since the start of the rally. That now comes in at 3300. I would expect at some stage that this is going to flatten out, and then we will see 1 or 2 dips below the Bollinger Band just to get everybody into a panic. But this is, to me, perfectly normal. I think the fundamentals are still completely identical. We haven't seen a single reason why we should change our minds about anything. The spreads are still all positive. There is absolutely no indication that the Fed is changing its policy, that the yield curve is warning of anything, that anything is happening to change our longer term minds. I think yields are going to be stuck where they are now for the foreseeable future, and really any kind of decent retracement towards into the 3200s or middle 3200s over the course of the next couple of weeks is going to pay off handsomely when we buy long-term calls, and I think we get to the 3,800 to 4,000 level sometime between the end of this year and the middle of next. And finally, to the lowest time frame that's worth looking at, and that's 300 minutes, you can really see that why we stay below 3500, we're putting the pressure on constantly on these longs here, who, we need to keep trapped if we're going to go down. The market is orderly, okay, goes below the Bollinger Band, stops everybody out, comes back above it, goes back to rest it, goes up above it, comes back down. We are not going to be moving a million miles away from this Bollinger Band, which basically says that, yes, can we make a partial new low next week? Sometimes Tuesday, Wednesday, yes, of course, but it's not it's not going to be easy. I think it's going to be a week of buy the dips and sell the rips. Eventually, can I see this 3230 area? Yes, possibly, but I think we need a lot more definition. I think this can be an ABC followed by a decent B followed by a decent C. But it's all going to take time. I really don't think that we are in any kind of a different market than a correction to a very strong uptrend, which is going to be fought at many levels. And really, the really good levels are going to be between 3280 and 3300, followed by 3233. That to me is going to be a wonderful level eventually, but I think it's going to take an awful long time to get there. I don't think it's going to be impulsive in the slightest. But no doubt to me that the biggest risk reward is going to be buying this dip when everybody else is worried about the election, and the market then is going to start climbing the wall of worry. There is absolutely no way that I think that the market doesn't start rallying again at least a week before the elections. It would be too simple. I think it's going to be a sideways to down market until about late October, and then it starts rallying just before the election. The US dollar gave us absolutely no clues last week. It's proving that this trend line is very, very important, and these levels are equally important. It's a 50-50. It really is a very bad risk reward for either side now, until we either get a completed break or we get the retracement up towards the 95 area. I would leave it well alone. I still think that one around the 115.70 in Euro USD is going to be a great risk reward for the upside, but we're not seeing it, and that equates to around this 95 something level in the Dixie. Where's the risk reward here? Who knows? It's such a 50-50. Maybe people don't want to have too much of a position on ahead of the US election, and they wait until they know what is going to happen before they try and force either side. It makes sense that nobody is going to take too aggressive a position ahead of the ECB on Thursday, when Lagarde will possibly be even more dovish than the Fed. It seems to be a race to the bottom at the moment, who can be more dovish than the other central bank, in which case Dixie is more likely to start going up a bit, but I still think that 115.70 area in Euro USD is going to be a very good risk reward for the upside again. Gold, actually, I was very disappointed by how it traded all week. The dollar wasn't particularly strong. Bonds weren't particularly going up, yet every time you got anywhere near 2000 you got smacked, which tells me this is a period of consolidation. It's a period of consolidation in the USD, and also it's a period of consolidation in bonds, which tells me that the weaker side is the downside. down towards the 1860 area. You know, a repeat, this is a monthly chart, and a repeat of this, I keep on saying it, I think it's going to take a long time for gold to start busting higher in terms of the trend to reassert itself. I think this consolidation, both in the weeklies and the monthlies, is very, very good, and the support levels around 1860 and especially around 1765 are going to be wonderful levels to get reaction longs. But for the time being, until we get clearer policy out of the ECB and we can gauge the direction of the euro, the path of least resistance is a consolidative path, i.e. down towards the 1860 area rather than straight up. And why not? It's done so well this year. A nasty dip just to shake everyone out would not be a surprise at all. But I think it's a buy. I don't think that precious metals are going to be weak for the next several years, simply because I don't think that the bond market is going to offer any kind of return. I don't think that US dollar is going to be very strong as a result, and therefore precious metals are going to be bid at very important levels, the most important of which to me is 1764. There's very little actually that I've changed in this table. To me the 2s, 10s are completely stuck, and they've done nothing all week. To me the 5s, 30s are the all-important one. And as long as they keep on holding the 140, and I really don't expect this to be broken for a long time, there is absolutely no reason to do anything. To me, the more worrying thing would be if it starts going through 105. That would indicate to me greater weakness in equities, but I don't expect it. I really don't expect it. If I see anywhere around 107 to 105, I want to go for a steepener. I haven't changed anything in Dixie, even though it's mildly stronger, because really nothing's changed on that chart. You know, I would love to see that area. I would love to see the 95.5 to 95.80 area, because I think it's a great risk reward to short it there. Gold, you know, nothing to change. Nothing's changed. 1860s is still support, and around the 2000 level, 2010 on a weekly Bollinger is your sell level. There's absolutely no reason to expect gold to do very much, you know, apart from a little dump to the 1860 level, unless these components up here change, and they're not changing. The levels here are now, to me, 3280, 3300. Can we see 3280 to 3300 next week? Yeah, okay, I'm not 100% sure, but that is the really good risk reward. If we see those, you know, you buy calls with both hands. We are unlikely to see anything higher than 3500. That reaction high, you know, maybe a few ticks, but I think it's basically we're transitioning, as I've said before, from buy the dip exclusively to buy the dip and sell the rip. 3280, 3300, I'm a very happy buyer. It'll all be in the sign of NQ. Basically, NQ is SPX turbocharged on both to the upside and to the downside. 11,060 is still crucial to me. As long as we hold it, we are likely to get reactions higher to give us some definition to the pattern. I really don't expect it to be any higher than 12,000. Anything with a 12,000, I think it's buy some puts for a move back down towards 11,060. The really good risk reward is going to be around 10,500, but the market is unlikely to give it to us for many weeks, if at all. And that's all I have for you this week. I think nothing has changed. Anybody who tells you that this has been anything but a week of very reasonable deflation in a sector which was hugely overbought, and something that was supposed to, was bound to happen before the election. The only question was when. Well, we got the answer. It was last week. Big deal. Let's concentrate on trading it from very good risk reward buy levels to very, very good risk reward sell levels. That's all I have to say. Thank you very much indeed, and have a wonderful weekend. Tweet you on Monday.